Boutique hotels can be an amazing vehicle to create a lot of wealth and a lot of cash flow. But if you buy wrong by paying too much or just have bad debt, you may either miss that equity by not being able to buy it in the first place, or worse, losing the property because you had a bad capital stack. And bad debt, in my opinion, is primarily variable rate with a short-term balloon payment where your note comes due in 12 to 24 months before you might be able to get the property properly stabilized. And when that rate goes up, it could either kill your deal, or when the note comes due, it could be taken back by the bank. So how you finance your deal is really important. And there's two parts I want to break down for you: the purchase and the refinance. Because in order to create a lot of value, there has to be a spread of what the property is worth when you buy it and when you get it completely fixed up and season the property or have it renting for 12 months. So you're likely going to refinance instead of selling so you can continue to hold the property for the long term, keep it cash flowing, and benefit from the future depreciation and the tax write-offs. That's the name of the game in real estate. And that's how I've done all my boutique hotels. They're basically big BRRRRs or Airbnbs. If you guys are new to my channel, my name is Blake Daly, and I've bought 5 boutique hotels over the last few years and scaled up to 85 units with over $3 million a year in revenue.
So raising money and getting debt financing and refinancing to pull out equity is something I've done a lot. And before we get into it, everything on this channel is free, and I just want to ask you guys that you hit the like button and share this video to someone else who may find it helpful. So financing hotels is something I get a lot of questions about, so hopefully this video will demystify it a little bit for you guys. And the first step to getting financing you can live with up front, and I say it like that, like financing you can live with, is because most of these kinds of properties are not your sparkling gems going in. Like, they need you, the fearless investor, to make them shine. They often have poor financials, if any at all. Like, once I got just numbers on a grid piece of paper, like for their P&L. So it takes some work to get financing sometimes. That's because banks want to see things like financials and loss runs for insurance and just basic due diligence items. And some of these hotels can run completely independent without much, if any, of that, because they're mom and pop operators that don't need to do anything more because they don't have bank loans or investors, and they just do their thing, which is great for them, but the property and financial condition of the property makes it tough to get financing. So here are some options for you to pursue financing for boutique hotels. And number one isn't the most ideal, but it's all cash. That helps you surpass all this due diligence items and going through the bank. So if you can pay all cash, either yourself or raising money from investors to purchase cash and then refinance later, it'd be a quicker and maybe easier way for you to get in and get started in boutique hotels.
Another one is bridge debt or mezzanine debt, which is shorter term money that is more flexible, but you usually pay for it in the fees and interest. Like, those kind of loans have a lot more flexibility with the condition of the properties going in and the due diligence items you can get. They'll basically lend conservatively off of the strength of you as a buyer and the strength of the upside of the property in your pro forma. And another one is institutional hard money. It's basically bridge debt with specialized lenders for commercial real estate. It could be things like multifamily, or in this case hotels, that they raise money from investors and then they lend that money out to you as the property investor. And another really good one going in is commercial loans with local banks or credit unions. Those are much more flexible, very based on your relationship with that lender. If you're in your local market, you've been investing, doing loans with somebody in that market from that bank, taking that relationship, taking that deal to them becomes much easier. So if you can build relationships with local bankers, they can be more flexible with you. You can also use SBA loans. They have loan to cost options where they will lend on both the purchase and the repairs. And like for a normal loan to value or LTV loan, on $1 million purchase, you're likely going to have to bring 20 or 25% down, or $250K for $1 million property. Now with a loan to cost loan, if you have $1 million purchase and $500,000 in repairs, they'll end up to 75% on that $1.5 million, including both the purchase and the repairs, meaning you have to bring less out of pocket for your down payment. But be careful and be prepared, because SBA loans can have a lot of red tape, a lot of hoops to jump through, and take 60 to 90 or even 120 days to close. So you have to have a seller who's willing to, have some extensions in the contract or have a longer due diligence period so that you can get through your financing with the bank. My favorite is seller financing. That's when the seller acts as the bank and they hold the note or carry the mortgage for you, meaning you'd send the down payment to them, they'd have an interest rate on the loan balance of that loan, and then every month you make mortgage payments to the seller, which, as you can imagine, is much more flexible than any bank loan you're going to get, due diligence is basically up to you as the investor in that relationship with the seller. Just make sure that if you do seller financing, you're working with a competent party that's actually financing the deal for you. Went through a situation where you don't want to have a bad seller that's carrying the note, then just opens you up to headaches later. But it is a great way for you to negotiate your interest rate, your down payment, and have flexible terms to get into this. That's why I love boutique hotels, is that seller financing is very, very available in the space. Now, the financing options I just described explain the debt portion of your capital stack. And capital stack is just the organization of the capital or the money that you bring to the deal. Now, with all of these, with the exception of all cash or 0% down seller financing, require a down payment. Now, that's the equity piece of your capital stack. This is the money you either need to bring to the deal yourself or raise from investors. Now, raising capital is a whole different subject and a different skill than getting good debt financing, but eventually you'll need it. Like, capital in the form of money you're able to raise is really the ultimate limiting factor to your growth. Like, you can have all the debt lenders and all the deals in the world and the ability to run and manage those deals, but without the capital you need to fund them, you're going to be stuck. And boutique hotels are bigger deals with higher purchase prices, so if you want to scale, eventually you're going to have to raise capital. Of course, I got a few tips for you guys for raising money. Like, you guys didn't think I was going to leave you hanging, did you? So number one is call everyone you know and tell them what you're doing. And a little ninja trick for you more deferential budding capital raisers is to ask them if they know anyone that's looking to passively invest in deals. This kind of eliminates that direct ask and allows them to easily say no without rejecting you and getting your feelings all hurt. And it also gives them the opportunity to refer other investors to you, if they don't want to be the one to invest, or even, give you an intro and set the stage for you with that next person. So don't be afraid to ask and pick up your phone and call people, let them know what you're doing, and present that opportunity. Remember, you're not trying to take people's money, you're presenting them an opportunity to invest their money and have their money work for them. You're just the vehicle of which they're doing that in. And the second is use social media. I don't think there's a better place in the world to raise money. You have to let people know what you do and what you're looking for. And social media allows you to get in front of the masses with both of those things. Now, you have to be careful of SEC rules. In most cases, you can't openly advertise a deal unless you do a 506c raise. But you can set the stage and use social media to connect with new people, make relationships with potential investors. Number three is build your email list with lead magnets. So create something valuable that people want and then give it away for free in exchange for people's email addresses. And that builds your list of people that you can communicate directly with and then share your deals with them when you have them. And you can, do those lead magnets on the link in your bio on social media, post them out on social media, even boost posts towards those lead magnets so you can collect that information of, and start to build the people that know, like, and trust you through providing them value. So once you purchase the property, you fix it up and improve the value and the income, you'll likely want to refinance and complete the BRRRR process and get your money out. And it's tax-free because refinances are not a taxable event, and then you can use that to go buy the next property. And this is how you really scale. Now, when you go to refinance a property, you'll be looking at slightly different financing options, but usually much better terms for you that are able to be held for the long term. And some are the same, but with different terms, like on the loan terms themselves, that'll be more favorable to you because by this time the property will be fixed up and hopefully seasoned or have those 12 months of operating financials that you can then show the bank the proof of concept to get those better terms. And if you don't have your property seasoned yet, you can go do another bridge loan and refinance your purchase financing to bridge debt for another 12 to 24 months. And if your project's done, you should be fairly confident that in 12 months, you'll be able to be in a better spot to be able to refinance. And it'll allow you to capture some of the equity you created and maybe pay down some of the principal of your investors and return some of their capital and yours while you continue to hold and continue to cash flow the property. But be careful though, because you don't want to put yourself in a spot where you have bad debt like we talked about earlier. The goal is to get long-term fixed rate debt, fixed for at least a period of 5 years and at a decent interest rate where you can pull out some of that equity tax-free and continue to hold for cash flow without the fear and that pressure of a balloon payment, that normally is 12 to 24 months. Next up on refinancing is local banks and credit unions. So no one is going to have more faith in your property than local lenders. They know the local area and the market forces, and they also have quotas of loans that they have to be able to give. Your goal here is to build relationships with these lenders so that they can be your go-to and give you the best terms after the deal. And make sure to give them progress updates. Send them some pictures via email and just show them like, hey, this thing's working, so that they stay more familiar with you and strengthen that relationship and are more likely to lend that money when you need it. Now, we talked about this one before, but the SBA, again, you can use that to refinance. And again, it's more hoops to jump through. It's a longer process, but still good, a still good funding option. And one thing to be aware of, it's not actually the SBA lending money, but the SBA working in partnership with approved lenders, including local and national banks, to guarantee a portion of the loan's proceeds in the event that the borrower defaults. So again, it comes back to a relationship with the lenders, as long as they're like a pre-approved SBA lender. This arrangement allows these lenders to approve funding for small businesses and borrowers who may not otherwise qualify due to the relatively high risk involved with small businesses. So which these are boutique hotels, so it'd be a perfect option for you as long as you have the runway to be able to, go through 60 or 90 or 120 days and all the hoops you have to jump through with the SBA. And finally, I'll leave you guys with this, is just pick up the phone and call every bank. It took us about 16 lenders to find our refinance for our Florida hotels, and it was refinancing with bridge debt because we wanted to return capital to the investors. And I'll say, like, hospitality, especially like smaller hotels, can be hard to finance, and this is where it takes you as the hardworking investor to find an option that works for your deal. So don't give up when you hear no or even 10 no's. Like, keep calling, and in my experience, eventually you'll find one. I think necessity breeds creativity and opens options that you didn't know were there, and you might find the exact perfect lender that ends up lending on all your future things. So each phase has its nuance and different requirements, whether you're purchasing the property at the beginning or refinancing once the project is complete to take out your equity. And in a perfect world, you can get all of your money out when you refinance, pay back your investors, back their principal, and get all of your money out, and then essentially have no risk, and then just continue to operate, collect cash flow, and just do your thing, running the business. And I'd say in today's market, that perfect Airbnb is hard to find, and you may have to find a way to make the numbers work, leaving some of the capital in the deal. It just has to have the cash flow to cover the increased debt and continue to provide a good return for you and your investors. And the key with this strategy, and just real estate in general, is to get a good deal, right? Like, focus on finding good deals in the first place, and then put financing in place that makes sense based on the deal. I think if you find a good deal with good equity spread, it seems obvious, but if you have that spread going in, you're going to have more options to both refinance or purchase and refinance. If you guys have any questions on financing, put them in the comments below, and I'll try to answer all of them, or at least point you in the right direction. So much of it is deal dependent, but if you make yourself aware of all the options, you'll be able to match the best lending option to your specific deal. If you guys want to keep learning about boutique hotels and scaling short-term rental businesses in your portfolio, subscribe to the channel, and I'll see you guys next time.